How did the accounting department measure plant performance?
Hello, Al. I am here to address your question regarding how Unico measures plant performance. Here in the accounting department, we use the conventional accounting method, and I have created a diagram to help put things in perspective. This method includes three primary measurements: net profit, return on investment, and cash flow. These three measurements can be classified as absolute or relative. Net profit tells us how much profit we have made in a given time period. This is achieved by deducting expenses, including taxes paid from revenues. Net profit is classified as an absolute measurement because of its limitation of disclosure on total plant performance. However, the return on investment tells us how much money we have earned or gained from the monies or funds that we have invested. For example, Al, if you invested $1 million and only made $100, that would not be very profitable. Return on investment is classified as a relative measurement because it gives a comparison to money made relative to money spent or invested. The third measurement, cash flow, tells us how much cash is coming in to pay our expenses. We know that if we can't cover our expenses, then we would not continue to be in business very long. And now I would classify this measurement as both absolute and relative because it gives us a hard number and it is in comparison to cash on hand relative to expenses we can cover. This is the ultimate measurement that determines if we stay in business or not. Now, if we keep cash above this threshold, then we can maintain our business. Please keep in mind, though, that there are pros and cons to this conventional method. Al, I hope this answers your question, and if you have any further questions, please let me know.
What are the pros and cons of assessing performance this way?
Pros to traditional accounting, it seemed to be the best process for how they initially ran their plan. It doesn't create a major difference when calculating the costs, then it provides an accurate figure that can be added as a rate to the finished goods or service. It's pretty simple. You can determine the average overhead rate under the traditional accounting system. All you have to do is calculate the time it takes to produce a product or service, the average rate of labor or machine use cost per hour, then multiply by the length of time necessary to create a sellable good or service. It's easier to determine what goods or services offer the best profit ratios. The reports generated by this calculation are often easier to read and understand because it puts everything in the dollars and cents category. It gives everyone looking at the metrics a basic view of company financials. Traditional accounting offers the ability to trace direct costs. Anything that is related to a specific product, including direct labor and materials, is included with this information. This makes specific metrics like inventory turns, total sales, total expenses, and direct labor variances simple to calculate. Some of the cons of it, though, is, the previous way to maintain the cost advantage and to stay efficient, they had to consistently keep producing. That created several problems within the process. Any unanticipated expenses are ignored when the traditional accounting system is used. It may cost an organization more to manufacture goods or services after the first projections are made, and there is no way that this accounting system can take that into account. So the metrics that could be used for like hours worked and hour output met per hour, cost of products, and direct labor variances doesn't show the complete picture. The traditional costing system does not show enough specifics to identify where waste might be occurring within the system. The indirect costs of manufacturing products and providing services are not accurately accounted for under that system. This is how they ended up with inflated inventory and work in process. The traditional accounting system wouldn't look at marketing, sales, or outreach costs because those happen after the manufacturing process. If those costs are high, then the system might indicate profitability for the company when none exists. So clearly it doesn't give the organization good visibility. The visibility they get is not a true picture of the manufacturing process.